What I call a sources and uses of funds statement, what many accountants call a cash flow statement, is absolutely key to the business. We want to know what's happening with the cash. When are we getting cash in? When are we having to pay cash out? This is a very good summary to have and to remember that anytime you decrease an asset, anytime you increase a liability, that's a source of cash. Cash is coming in. When you do the opposite, whenever you increase an asset or decrease a liability, that's a use of cash. Think of some examples of why that must be the case, why decreasing assets and increasing liabilities adds to your cash, and why increasing assets and decreasing liabilities subtracts from your cash available. Again, a concept you will use repeatedly. Statement of cash flows just summarizes what these changes are. Now, in accounting, they're divided into operating activities, investing activities, and financing activities. Honestly, not something that we will be overly concerned with. We're just more concerned with what are the changes that are going to take place, and are these going to add cash to the firm, or are they going to mean cash is going out of the firm? It often is important and useful to standardize financial statements. Later on in the class, when you do your discounted cash flow project, you will create a common size income statement, and a certain part, not the entire balance sheet, but part of the balance sheet as a common size balance sheet. Typically, as your textbook says, accounts are going to be a percent of assets in a common size balance sheet. We're actually going to do everything as a percent of sales. If you consider that assets are a percent of sales, well, then the entire balance sheet is a percent of sales as well. This is going to make it easier for us to compare financial information, see how the company is doing year over year. You will be analyzing your company, doing a ratio analysis of your company, and having standardized statements is going to make that ratio analysis easier. In ratio analysis, this is a way to standardize numbers and facilitate comparisons, to highlight the strengths and weaknesses. Ratio comparisons should be made over time. Is the company improving or declining over time? And how are they doing relative to their competitors? This is what part 2 of the project is all about for you. You will be calculating ratios, comparing those ratios to your company over time, and comparing those ratios to an industry average. Some of the categories of financial ratios. Long-term solvency or liquidity. Can we make the required payments? Do we have enough cash to make the required payments? Things like the quick ratio, the current ratio, credit scoring. In credit scoring, you might take several ratios and take an average of those ratios. Creditors are really interested in short-term solvency and liquidity ratios. Long-term solvency or leverage ratios, creditors are still interested in these. Here we're saying, do we have the right mix of debt and equity? Are we over-levered? Do we have too much debt, or do we have the right amount of debt? Asset management or turnover ratios, are we being efficient in our use of inventory, in collecting on accounts receivable? Are we being efficient in our use of fixed assets? Profitability, do sales exceed costs? Are sales high enough to be reflected in the profit margin, the return on equity, and the return on assets? And finally, market value. Do investors like what they see as reflected by the price to earnings and the market to book ratios? Again, all ratios that are of a great deal of importance to creditors and to investors.